Hey everybody, Brian Shannon here from Alphatrends.net. Today's Friday, the 28th of February, 2014. Let's look at these markets. We finished out a strong week with a very strong month as well. We finally saw this S&P 500 close in the year-to-date positive column on a weekly basis. And for the month, 4.5%, 6% for the semiconductors. Just a real great environment for equities. And of course, we've had some volatility. So let's take a look at the charts here and see where we're at. We've had this really big run in the S&P 500 off the lows at about 173.5, and we've rallied 13 points here, basically about about 11% or so off the lows. And this market is showing a little bit of volatility up in here with the late day pullback, but that pullback came right down to the rising 5-day moving average. And the fact is, we still have a pattern of higher highs and higher lows with a rising 5-day moving average, and that tells us, as always, that the market is innocent till proven guilty. We came down to the 5-day moving average. We came down to a trend line that's been in place here and tested those levels. So I think that for next week, of course, this little area, 185.5, is going to be our first near-term level of support to keep an eye on. But we're not likely to have any trouble in the market until we get back down below probably 183.90 to 184.05. This is what I consider to be the more important band of support. If we break below that, then we have to start looking at things such as what's the volume weighted average price since this rally. Well, that's down at about 182.30, and that's kind of coincident with this little pullback low right in here. We can also look at a Fibonacci level to see an approximation of where we might pull back, and a 38.2% retracement will get us down to 182. So breaking below 184, then perhaps we have the chance that we're going to head down a little bit further down towards 182, and we have a 50-day moving average in that area as well. So again, the primary thing to take away here is we are in an uptrend, so it's innocent till proven guilty. We're extended, and there's a lot of anxiety about whether this market can continue at this pace. Obviously, in today's session, we saw that as soon as we broke this volume weighted average price here, and I'd warned people in chat that it was looking weak because we saw a lot of momentum names prior to this breakdown. We saw a lot of momentum names coming in quickly, and we saw a very sharp and quick sell-off in the S&P 500, but we rallied back really much better than I thought we would for sure, and right up to that volume weighted average price. So again, if you rush to get short all at once or just throw your stocks away, step back just one time frame and say, what's the bigger picture? What is the true trend of this market? What's the structure? And we're obviously still in a primary uptrend. If we start to see more volatility and then we break below this 184-ish level, then that's what the market will tell us. But until the market tells us that it's breaking down or that it's below a declining 5-day moving average with lower highs and lower lows, then we have to look at it as innocent until proven guilty and seek out the low risk, high probability trades. Our job is always the same. It's to manage risk. Now the NASDAQ, again, the NASDAQ did have a decent week, up a little less than 0.5%, and for the month, 4.7%. But you can see it was clearly an underperformer here this week, and of course it closed with a loss today. It seems as though the NASDAQ is just kind of churning up in here, and really if we look at a weekly time frame, we're still in a primary uptrend. It's really an extended uptrend, but an uptrend nonetheless, and we're running into maybe a little bit of resistance here that we broke to a new high today and then sold off quickly. So that reminds me of the phrase, from failed moves often come fast moves in the opposite direction, and there's nothing here indicating that we're breaking down. I think the important level to monitor next week will be basically between $89.40 down to $89.50. That's our little band of support that we want to see hold. If we break down below that and then we see that 5-day moving average start to decline and we see lower highs and lower lows, then we'll need to look and say, where does it have the potential to pull back down to? We can look at the 50-day moving average coming up towards 88. We can also look, as we did with the S&P 500, at some Fibonacci levels here and say a 38.2% retracement would get us down to 88.12. And again, that's kind of coincident with where this 50-day moving average is heading. Don't forget, of course, the moving average, it moves. So look at where it will be in the next couple days, if it continues at this ascent, we could see that the 50-day moving average would maybe catch up to that 88 level. Again, there's nothing here saying it's time to be short this market. It's just saying that we're undergoing possible distribution, or is this just a pause before it continues to advance? After a big move like this, it's normal to look for a correction. So far, what we're seeing is it's correcting through time, and there's no danger, and real danger to the intermediate term until we break down below about that $89.35 level. The Russell 2000 has had just a real spectacular run here after touching that 150-day moving average 3 weeks ago, and we can see here on the 30-minute time frame, we've been looking at this trend line, and this is really, capturing the essence of trend along with that rising 5-day moving average. We broke the trend line, but it doesn't mean, as I always say, breaking a trend line doesn't mean the market's going to head lower. It means that the rate of ascent has slowed, and perhaps it's time for some consolidation in the Russell 2000. You have to look at the daily chart and think, here we broke out to a new all-time high this past Thursday and Friday, and now where did that, where's the market come from? It just came from this 107-ish level, so rallied 10 points or about 9%, uninterrupted really. So we're still in a primary uptrend. That's the key takeaway here, and we've got higher highs and higher lows. I think that the more important level to begin to start to get concerned next week is if we were to break down below about 116 and a quarter, breaking back below that level. And I wouldn't say just breaking down all at once, because that would make it oversold, but if we come down to that level, then bounce a little and create a higher low, the 5-day moving average, a lower high rather, and the 5-day moving average starts to flatten, then if we begin to pull back, I think that the bigger, more important level of potential support is down at about 114. You can draw some Fibonacci's yourself with some of the free programs out there for technical analysis, including free stock charts. TradingView.com is a good one as well. But the semiconductors, these guys hung in there this week as well. We came down and really gave us a little bit of reason to start getting concerned that we might be headed for a breakdown as the market was below the 5-day moving average. But it held the 43 level. What would have gotten us bearish would have been something that looked like this. If it did, something like that where it broke that 43 and then the 5-day moving average would begin to decline, that's what gets us bearish. We get cautious right here. We get bearish when it breaks the lower low, and then we manage risk accordingly. So the semiconductors, again, next week, $43 is going to be the key level for this market to hold. The financials had a decent day here today, up 0.5 percentage point, but they're still kind of stuck within this little range. Let's take a look at a 65-minute chart. We've been talking about this as our band of resistance right in here, that this has been the band of resistance, and here's been our band of support, that we've been kind of neutral within this range. Well, we broke the high end of that, and we closed right at the top of it, so it's not quite clear that the buyers have really wrestled back control. I think that the key level, I'd love to see 21.5 hold. If that were to happen, that would be great for the financials. But if not, I wouldn't be concerned about it unless we get back down towards about that 21.35 level. So still kind of neutral, intermediate term on the financials, but they certainly improved a lot this week. Some of the stocks, Amazon bounced from that 61 point, I'm sorry, not Amazon, but Apple bounced from the 61.8% retracement almost precisely, and that was actually where we saw a daily S2 on Thursday or Wednesday. But we saw it almost precisely. Again, we saw the market break, have this real strong rally. It broke down below the 5-day moving average and lower highs and lower lows. We came to the we came down to the 61.8% retracement. And it's also interesting to see that since the event, that is the gap, the volume weighted average price has been at about 520. So it appears to me as though Apple is trying to consolidate here, hold above this 5-day moving average. It was good to see this pull back today because the 5-day moving average was still declining. Now next week, if we can get this stock back up above about 533, 533 and a half, then I think it has a good chance of making another run for that 550-ish level. A couple other names I wanted to talk about. Tesla last Thursday on CNBC, I was talking about Tesla right in here, saying that I still like the stock with a stop down just underneath this level here. And I'd been mentioning and tweeted about it on Wednesday. We had raised our stop in the Alphatrends chat room to 252, and that's where the stock stopped making the pattern of higher highs and higher lows as far as I was concerned for our swing trade needs. Now I was talking about the possibility of heading up to 270, and some people might say, well, how come you're not holding? I thought your target was 270. It's 270, but I didn't expect it to happen that quickly. And what matters more than that is what's the pattern? What is the market telling us? You take these big gains and move to the sidelines. It's gotten a little bit ahead of itself, perhaps, and it looks like Tesla may need to correct a little bit. The other one I'd mentioned on CNBC was Caesars Management. Caesars was right here exactly at 23, just crossing 23 when I mentioned it, and I'd suggested a stop in here. It was a daily chart I was looking at. I said a stop should probably go underneath this level right here. Anyways, the stock rallied very nicely, and I had suggested raising stops. We got stopped out here at $25.20. Now the stock continued higher, and I didn't sell the top, but guess what? Only liars consistently sell the top. What you want to do is identify your time frame, and if it's a swing trader, you listen to the message of the market on a swing trade time frame, such as this 10-minute chart that we're looking at, and say what's the pattern, higher highs and higher lows, and as long as it continues to make that pattern, I'm going to be objective and hold the stock regardless of what my price target might be. And here's something that happens quite often too with stocks like this is, people look at them and say, hey, Caesars is breaking out. Don't buy these breakouts. They typically do not hold, because you have to ask yourself, where has it come from? It's just come from 20 bucks a share to 26. It's extended at the point of breakout, and now I still think that Caesars probably needs to pull back a little bit. If you're more than a swing trader, then you're going to want to have your own stop in there. But right now, I think that that's the proper way to trade it, and I don't mind at all not selling the top or leaving some money on the table. The point is, identify your time frame that you're comfortable with. Use an objective approach to the market, which in this case is multiple time frame technical analysis, and let the market do some work for you. We had some great winners in Alphatrends this week, and I'm sure you did too. I mean, it's an easy environment, but we got involved in the CUR right here. We got involved in Solazyme right in this day and got lucky on that gap. We got involved in PCYC right over in here last week and sold into this gap, which is a great thing because look at how it pulled back and gave the entire thing back. To me, this is unforgivable. We bought the stock right here, and what would be unforgivable is to be still holding it. To let a trade that went from 140 up to 155 to see that turn into a loss, to me that's unforgivable. But again, you have to do what's right for you. Plug was another good one this week, and we got involved right here and got lucky on that gap. And this was a fantastic one. I didn't hold it as well as some of the other guys in the chat room did, but we got involved in it on Thursday. We were talking about the possibility of it going to 350, and this one just continued to ramp higher. It was up 25% alone today, and for people that are holding that, they should have their stop at about 360. So thanks for tuning in. If this doesn't make sense to you, look at some of the other videos I have on YouTube that are more educational about the concepts, or consider a free trial to alphatrends.net. Thanks for tuning in, and have a good weekend.